The IMF has just cut forecasts, growth forecasts, that is rather sharply by 0.5 percentage point for world GDP. Thanks to the tariffs and world GDP growth, according to the IMF, will now slow to 2.8% in the current year from 3.3% last year. Asia's growth slows even more sharply from 5.3% last year, 2024, to 4.5% in 2025. Though India is relatively less impacted, IMF has cut India's GDP forecast for the current year to 6.2% from its earlier forecast of 6.5%. Joining me to discuss the IMF's fears and forecasts with respect to Asia is the Director, Asia Pacific Department at the IMF, Dr. Krishna Srinivasan. Let us assume that there are some understandings, negotiations between Asian countries and the US. Do you think this is the worst forecast? Do you think we may perhaps have a better growth rate if negotiations succeed?
So, Latha, if I could just back up a little bit. So we have a growth forecast for the world at 2.8% for this year, and for next year, it's 3%. This is a cumulative reduction of about 0.7 percentage points relative to where we were in October of 2024. Now, these forecasts are based on the tariff scenario which prevailed on April 4th, right? So based on that, these are projections. Now, these projections take into account the trade tensions, the heightened uncertainty, and a tightening of financial conditions. The question, of course, is, since then, there's been a pause in tariffs. So that is something which we don't take into account in this scenario. Of course, if countries reach agreements with the US and so on, then you could see a better forecast, but that would be an upside risk. But there are significant downside risks to the forecast here because there's what we think is very high uncertainty, right, in terms of these trade agreements, how soon they'll be reached, what will be the terms of it, how will it affect various regions of the part of the world. So all that is up in the air. So there's a huge amount of heightened uncertainty. There's a lot of, what I would say, financial market concerns. So all that put together is significant downside risks to our forecast.
That's what I'm worried about. I'm not worried so much about the upside risks. That would be welcome. But right. What about the downside risks to your forecast? I'll tell you why. Even if we reach negotiations, it appears that the US will go with 10% on all countries. That hasn't been removed. And that 25% on steel, aluminum and autos stands. And of course, bigger tariffs on China. Therefore, if you compare to the pre-April 2nd period, at that time, US tariffs were 2.5%. Now it looks like the average is 25%. That's massive. So do you think we'll get away with even a 2.8% growth for the world and 4.5% for Asia? Or could it be worse?
So one thing is, as I said, these are based on April 4th tariff scenario. And from there, we see significant downside risks. It all depends upon what kind of trade agreements are reached, what kind of, how does it, between countries, how does it affect the whole issue of trade? I think that's all an important factor which goes into seeing how the downside risks materialize. Now, one point which I want to correct, Latha, is for Asia, we have for 2025, we have a growth rate of 3.9%, which is significantly lower than what we had in October, about 0.5 percentage points. And for next year, we have 4%. So if you take the 2 years put together, we have lowered our forecast for Asia under the reference scenario by 0.8 percentage points. And that's a significant markdown. I think I would say this is the sharpest markdown we have for Asia since the pandemic.
Mm-hmm. Oh, yes, that's true, because they were the countries most, targeted for higher tariffs.
It's not just the tariff, Latha. The fact is, a number of Asian countries were dependent on export of goods, and many of them had very sharp exposures, significant exposures to the US. If you think of the ASEAN countries, for instance, there were many countries where the share of the exports to the US was as high as 40%, for example, in the case of Cambodia. So those countries are affected quite significantly, on top of the fact that these countries were also hit by high tariff rates. So it's a combination of exposure to external demand and the high tariff rate across many countries in Asia, which explains why our forecast for Asia is even more revised down compared to other parts of the world.
Yeah, by the same logic, India's growth has been cut less simply
Yes.
because we are not an export-oriented country. But do
That's
you
right.
think, if not this year, at least next year, we will have some upsides because of investment relocation?
So that's definitely possible in terms of, if you think in terms of, we've been talking about China plus one for
Yes.
a long time. So if India benefits from that, that could be an upside risk to growth forecast for India. But again, that said, Latha, I think one thing which I would like to point out is we are worried about, even though the numbers for India have been revised on modestly compared to other parts of Asia, I am worried that private investment is still pretty lackadaisical in India. And if you look at parts of private investment, which is, say, investment in machinery and equipment, which adds to productivity in the economy and so on, that's been pretty sluggish. So if you really want to benefit from this, private investment needs to pick up. And for that, there are many things which are needed, including greater trade liberalization, fixing of our labor codes, boosting infrastructure and so on. So yes, India can take advantage of the opportunities, but for that, there has to be a handoff from public to private investment. That isn't happening to the extent that we would like in India.
Oh, yes. Private sector itself has to invest much more. Krishna, let me just zoom out a bit. I'll come back to India. This US bond yields, one thing keeps worrying me. What the US entire strategy of tariffs is not related to the tariffs of the destination countries, but it is more designed depending on the deficit they have with the US. So the US goal is to reduce deficit. Now, if we run a surplus with the US or a lower deficit, we will have fewer dollars with us. And in that case, we will buy, the demand for US treasuries will be less. So do you see a structural rise in US long bond yields?
So I would like to, I would disconnect between the two in terms of what US is trying to do in terms of reducing its imbalances across countries. Separate that from what's happening to the yields. I think the yields are, you have to take into account how the economic conditions are in the country, how the Fed responds, and how markets react to the outlook. So these are the factors which will drive yields. And what we've seen is there's been a lot of volatility in markets and yields, both in the US and elsewhere. So this is something which we have to wait and see to see how markets stabilize and how yields respond to that.
No, I agree. That is logically, that's how yields would go, depending on the interest rates and inflation in a specific country. But the US got a lot of demand from countries like Japan, China, India. We all hold US treasuries because it's the reserve currency. But if we have fewer reserves because we are forced to run a deficit or smaller surplus, then automatically the demand for those bonds go down, isn't it? So I'm wondering if there is a structural rise in US yields that we have to look at. Term premiums.
So I think if you look at the whole surplus and you look at the size of the US Treasury market, there's a huge gap there. So everything on what happens to the yields is not necessarily driven by what happens on the trade side.
Okay.
So there is a little bit of disconnect which you have to take into account. So the size of the market and the size of the US Treasury market, and you compare that with the surpluses in Asia, I think there is a significant gap there. And so that cannot be the only factor which drives. There could be some impact from there, but other market conditions, how the Fed responds, how the market responds to the various aspects there will have a bearing on the yields.
Okay. Yeah, let me very quickly come to inflation. You all have cut Asia's inflation marginally by 0.1%, I think, compared to your previous forecast. There are a lot of people who fear a huge disinflation in Asia, because if you're not able to sell goods to the biggest economy, the 4 trillion US export market, those goods will find a home elsewhere and they'll push down prices. Already we are seeing very low core inflation in India and in Asia. It will go down further, won't it? Don't you see big disinflation, bigger than what IMF has forecast?
So we do see disinflation. In fact, we see inflation across many parts of Asia coming to or below target, for sure. In fact, that's where we feel that monetary policy has more room to ease. There's more monetary policy space across many countries of the world. I think where we are really concerned about deflationary pressures are in countries like China, where clearly prices have been have been coming down very sharply. Both headline inflation, GDP deflator has been coming down in China. That has spillover effects into the rest of the region. And in fact, we highlighted that, Latha, in our last regional economic outlook, saying that when deflation risks rise in China, that has significant spillover effects on the rest of Asia, because prices of exports of China come down, and they are much more competitive compared to, say, the price of goods in other countries. So that is definitely a risk. But as far as Asia is concerned, we feel that given where we are today, the output gaps are closing and inflation is coming down to target. And so going forward, if you want to rotate towards more domestic demand, there's more monetary policy space. In fact, there's one point which I'd like to make, Latha. I talked about it at the beginning, that a lot of Asia is based on exports of goods to the rest of the world. And what we would think is that this is a good time to think in terms of a more balanced approach to growth, where there's more domestic demand coming into play. And there, if that idea takes hold, then you have monetary policy space which can help push up domestic demand in Asia. And that's a kind of balance we would want to see in many countries.
Okay. What are the chances of dollar weakness? I mean, if the US wants to reduce its deficit, are you going to see more dollar weakness? And also because of this, question marks over safe status of US bonds, does gold continue to rise?
So I can't say much about gold, but what I can say is, if you look at where the dollar is today, it's compared to where we were, say, 6 months ago. So that there has been a lot of movement. So this is one issue which, in terms of how market financial conditions tighten or loosen, has a significant bearing on prospects, including notably in countries in Asia. So I think that's something which we have to watch out for. I mean, it's something where you have seen a lot of variation in the exchange markets. It's not been so much compared to, say, the past. If you look at financial markets in Asia, in response to what's happening to the whole trade tariff friction, you've seen a lot more movement in equity markets. If you look at currency markets or bond markets, there's been a lot more stability there compared to equity markets. So the question, of course, is how will that all unfold going forward, something which we have to wait and see.
Okay. Well, running out of time, just a last quick question, because we have a big market audience. The consensus in India was that the RBI would cut rates all the way to 5.5% repo. But given the kind of disinflation that may come from Asia, you think India will have scope to cut more, even more than that?
So, I mean, again, all this is data dependent, and RBI will look at data very closely. Generally speaking, if you look at Asia, and that includes India too, inflation is coming down to target, or in some cases even below target. So that, in many ways, will imply that the space for monetary easing has gone up across many countries in Asia, including in India. And how the RBI reacts to that, it all depends upon how they see the data. But overall, I would say that is our policy advice to countries, is that you have monetary policy has more space to move. Of course, again, Latha, we have to be very careful here, because while there is monetary policy space, countries in Asia central banks in Asia will also look to see what's happening to the interest rates outside, and what's happening to interest rates in major advanced economies, because that will have a bearing on exchange rates, and and then pass through inflation and so on. Our advice is that allow the exchange rates to be flexible, and if there is significant volatility, then you could think in terms of intervention in very specific circumstances. Again, we have an integrated policy framework which provides a good playbook to look at, how should monetary policy respond, how should exchange rates respond. But overall, we would say allow the exchange rate to be a buffer against shocks, and allow monetary policy to be determined by domestic financial conditions. On fiscal policy, we believe that in Asia, there was a lot of fiscal spending, post-pandemic. Now it's a time to think in terms of consolidation. But here too, given the fact that some countries will face the shocks are facing significant shocks from these trade, tariff trade frictions, they could provide targeted and timely support for certain sectors which bear the brunt of the trade war. But overall, we believe that The policy mix should be allow the exchange rate to be more flexible, ease monetary policy because you have more space there, but consolidate fiscally because debt levels have risen. Countries have been spending a lot since the pandemic.
Okay, well, the two major regions are going to spend more from their fisc, Europe and China. Let's see how it goes. Thank you very much, Krishna Srinivasan, for joining us with your thoughts and the IMF's outlook. India gets away with a smaller brunt, but it's still at 6.2%, not a very happy number. That's it on this edition of It's the Economy. After a break, it'll be time for Chartbusters.